Question 1. What is the primary purpose of insurable interest in life insurance contracts? A. To determine the appropriate premium rates for a policy. B. To ensure that the policyholder has a valid financial interest in the insured's life. C. To provide a basis for underwriting decisions. D. To limit the amount of death benefit payable under the policy. Answer: B. To ensure that the policyholder has a valid financial interest in the insured's life. Explanation: Insurable interest is a fundamental principle in life insurance that requires the policyholder to have a legitimate interest in the continued life of the insured. This means that the policyholder would suffer a financial loss or hardship if the insured were to pass away. The Massachusetts insurance regulations mandate this principle to prevent insurance from being used as a gambling mechanism and to uphold the ethical standards of the insurance industry. In Massachusetts, insurable interest must exist at the time the policy is issued. If a policyholder cannot demonstrate insurable interest, the contract may be deemed void. This requirement protects against moral hazard, where individuals might have an incentive to cause harm to the insured if they stand to gain financially from their death. Thus, option B is correct as it encapsulates the essence of insurable interest. Question 2. Which of the following is not a standard provision typically found in a term life insurance policy? A. Contestability clause. B. Policy loan provision. C. Conversion option. D. Grace period. Answer: B. Policy loan provision. Explanation: In term life insurance, the policies generally do not accumulate cash value, which means that a policy loan provision is not applicable. A policy loan provision is commonly found in permanent life insurance policies, such as whole life or universal life insurance, where the cash value can be borrowed against. In contrast, standard provisions in term life insurance policies typically include a contestability clause, which allows the insurer to investigate claims during the first 2 years of the policy, and a grace period provision, which offers a time frame for the policyholder to pay overdue premiums without losing coverage. The conversion option allows policyholders to convert their term policy to a permanent policy under specific conditions. Therefore, option B is correct as it is not a feature of term life insurance. Question 3. Scenario-based. Mr. Thompson recently purchased a 20-year level term life insurance policy. A few months after the policy was issued, he became seriously ill and is concerned about his ability to maintain the policy. He wants to know what options he might have to ensure he can keep his coverage. What should Mr. Thompson consider? A. He should review the conversion option available in his policy to switch to a permanent policy without medical underwriting. B. He should allow the policy to lapse and look for a new policy once his health improves. C. He can request a reduction in his coverage amount to lower his premium. D. He should inform the insurance company of his illness to ensure his claim is processed quickly in the future. Answer: A. He should review the conversion option available in his policy to switch to a permanent policy without medical underwriting. Explanation: In this scenario, Mr. Thompson should consider the conversion option that many term life policies include. This feature allows the policyholder to convert their term policy into a permanent life insurance policy, usually without the need for additional medical underwriting, regardless of the insured's health status at the time of conversion. This is particularly important for someone in Mr. Thompson's situation, as his serious illness may make it difficult or impossible to obtain new coverage in the future. Options B and C are not advisable strategies. Allowing the policy to lapse can leave him without coverage, and reducing coverage may not address his concerns about maintaining insurance due to health changes. Option D, while it highlights the importance of transparency, does not provide a practical solution for retaining coverage. Thus, the most suitable option for Mr. Thompson is A, as it allows him to keep insurance in place while addressing his health concerns. Question 4. In Massachusetts, what is the typical contestability period for a life insurance policy? A. 1 year. B. 2 years. C. 3 years. D. 5 years. Answer: B. 2 years. Explanation: In Massachusetts, the standard contestability period for life insurance policies is 2 years. During this period, the insurer has the right to investigate and contest any claims made, particularly those relating to misrepresentation or omissions in the application for coverage. If a claim is filed during this contestability period, the insurance company may deny the claim if they find that the applicant provided false or incomplete information. After the contestability period expires, the insurer generally cannot contest the policy on the grounds of misrepresentation except in cases of fraud. This regulation protects both insurers and consumers by providing a clear time frame for potential claims investigations. Therefore, option B is correct as it reflects the applicable period under Massachusetts law. Question 5. Which of the following best describes the concept of level term insurance? A. A policy where the premium decreases over time while the death benefit remains level. B. A policy that provides a fixed death benefit for a specified period with level premiums throughout the term. C. A type of insurance that allows the insured to convert to a permanent policy at any time during the term. D. A policy that combines investment and insurance elements with varying premium costs. Answer: B. A policy that provides a fixed death benefit for a specified period with level premiums throughout the term. Explanation: level term insurance is characterized by having a fixed death benefit that remains constant throughout the term of the policy, along with level premiums that do not increase. This type of insurance is particularly attractive for individuals looking for predictable costs and guaranteed benefits for a set duration, such as 10, 20, or 30 years. Option incorrectly describes a decreasing term insurance policy where premiums may remain constant, but the death benefit decreases over time. Option C is more aligned with the features of a convertible term policy rather than describing level term insurance. Option D refers to permanent insurance products which blend investment features with insurance coverage. Thus, the correct answer is B, as it accurately describes the nature of level term insurance. Question 6. Which of the following is a common ethical consideration for insurance agents when advising clients on life insurance policies? A. Encouraging clients to purchase the most expensive policy to maximize commissions. B. Disclosing all potential conflicts of interest when recommending a policy. C. Withholding information about policy exclusions to avoid client objections. D. Persuading clients to choose a policy based on agent preference rather than client needs. Answer: B. Disclosing all potential conflicts of interest when recommending a policy. Explanation: ethical standards in the insurance industry mandate that agents must prioritize the best interests of their clients. This includes being transparent about any potential conflicts of interest that might arise from their recommendations. By disclosing these conflicts, agents can maintain trust and integrity in their professional relationships. Option A violates ethical standards by prioritizing the agent's financial gain over the client's best interests. Option C is unethical as it involves misleading clients by not providing full information about the policy. Option D also goes against ethical principles, as recommendations should be based on the client's needs and circumstances, not the agent's preferences. Therefore, option B is correct as it aligns with ethical conduct in the insurance profession. Question 7. Which of the following factors is NOT typically considered when calculating life insurance premiums? A. The insured's occupation and lifestyle risks. B. The insured's age and health history. C. The insured's personal financial investments. D. The insured's gender. Answer: C. The insured's personal financial investments. Explanation: when calculating life insurance premiums, several key factors are taken into account, such as the insured's age, health history, occupation, lifestyle risks, and gender. These elements help insurers assess the risk associated with insuring an individual and ultimately influence the premium rate offered. However, the insured's personal financial investments are generally not a factor in premium calculations, as they do not directly relate to the risk of mortality. Personal financial investments might be relevant in the context of overall financial planning, but do not impact the underwriting process for life insurance. Therefore, option C is the correct answer, as it is not a factor in determining life insurance premiums. Question 8. Scenario-based. Mrs. Garcia recently discovered that her husband passed away unexpectedly. She is now faced with the task of filing a claim on his term life insurance policy. What steps should Mrs. Garcia take to ensure a smooth claims process? A. Submit the claim form without any additional documentation to expedite the process. B. Contact the insurance company to understand the required documentation and timelines for filing the claim. C. Wait for the insurance company to contact her regarding the claim, as they will manage the process. D. Inform the insurance company about her husband's death and ask them to handle everything from there. Answer: B. Contact the insurance company to understand the required documentation and timelines for filing the claim. Explanation: in the event of a claim on a term life insurance policy, it is crucial for beneficiaries, such as Mrs. Garcia, to understand the specific requirements of the insurance company regarding documentation and procedures. This typically involves gathering necessary documents such as the death certificate, the policy number and possibly the original policy document. Option A is incorrect because submitting a claim without required documentation can lead to delays or denial of the claim. Option C is also not advisable. Beneficiaries should not wait for the insurance company to initiate the process, as proactive communication is essential in ensuring timely claims processing. Option D may lead to misunderstandings regarding what information is needed, as insurers will rely on the beneficiaries to provide complete information. Therefore, option B is the best course of action for Mrs. Garcia to ensure a smooth and efficient claims process. Question 9. What is the primary function of a conversion option ICA term life insurance policy? A. To increase the death benefit amount at the policyholder's request. B. To allow the policyholder to switch to a different insurance provider without underwriting. C. To convert the term policy to a permanent life insurance policy without medical evidence of insurability. D. To decrease the premium amount as the insured ages. Answer. C. To convert the term policy to a permanent life insurance policy without medical evidence of insurability. Explanation. A conversion option in a term life insurance policy allows the policyholder to convert their term coverage into a permanent life insurance policy, such as whole or universal life insurance, typically without the need for medical underwriting. This is particularly advantageous for policyholders who may develop health issues during the term of their policy, as they can secure coverage without the risk of being denied based on their health status. Option A is incorrect, as the conversion option does not inherently increase the death benefit, it merely changes the type of policy. Option B misrepresents the conversion option, as it pertains to changing policies within the same company rather than switching providers. Option D is also incorrect, as the conversion option does not relate to changing premium amounts but rather to the type of policy being utilized. Thus, option C correctly identifies the primary function of the conversion option in term life insurance policies. Question 10. What is a key difference between a decreasing term and level term life insurance policies? A. Decreasing term policies have higher initial premiums than level term policies. B. Decreasing term policies provide a fixed death benefit that decreases over time, while level term policies provide a constant death benefit. C. Level term policies are only available for short durations, while decreasing term policies can last for any period. D. Decreasing term policies are always renewable, whereas level term policies typically are not. Answer. B. Decreasing term policies provide a fixed death benefit that decreases over time, while level term policies provide a constant death benefit. Explanation. The fundamental difference between decreasing term and level term insurance lies in the death benefit structure. Decreasing term life insurance features a death benefit that diminishes over the term of the policy, often aligning with decreasing financial obligations, such as a mortgage. In contrast, level term insurance maintains a fixed death benefit throughout the policy duration, providing predictable coverage for the insured. Option A is incorrect because initial premiums for decreasing term policies are generally lower than for level term policies. Option C inaccurately suggests limitations on the duration of level term policies, which can be issued for various lengths. Option D incorrectly implies that all decreasing term policies are renewable, while some may not be, particularly if they are structured to cover specific liabilities. Therefore, the correct answer is B. Question 11. Which of the following best describes the contestability period of ICA life insurance policy? A. A time frame in which policyholders can cancel their policies for a full refund. B. A duration during which an insurer can review and deny a claim based on the application information. C. The period after a policy is issued when the insured can convert the term policy to a permanent one. D. A time limit for the beneficiary to file a claim after the insured's death. Answer. B. A duration during which an insurer can review and deny a claim based on the application information. Explanation. The contestability period is a critical time frame, typically 2 years, during which an insurer can investigate the application for coverage and contest a claim based on misrepresentation or omissions. If the insured passes away during this period, the insurer can review the application details to ascertain whether there were any inaccuracies that might influence the validity of the policy. Option A describes a cancellation period that does not pertain to contestability. Option C confuses contestability with conversion rights, which are not dependent on the contestability timeframe. Option D inaccurately relates contestability to claim filing limits, as the contestability period is primarily focused on the insurer's right to dispute claims rather than the beneficiary's action timeline. Thus, option B is the correct choice. Question 12. In Massachusetts, which of the following is not a required component of a life insurance policy? A statement of the policy's purpose and benefits. B. A detailed explanation of premium payment modes. C. A provision detailing the insurance company's financial condition. D. An explanation of the policy's contestability period. Answer: C. A provision detailing the insurance company's financial condition. Explanation: Massachusetts life insurance policies are mandated to include specific provisions such as a statement of the policy's benefits, premium payment modes, and information regarding the contestability period. However, there is no requirement for the policy to include details about the insurance company's financial condition, as this information is typically available through other means, such as state insurance department reports and ratings agencies. Option is incorrect because a statement of benefits is a necessary inclusion. Option B is also required, as consumers must understand their payment options. Option D pertains to mandatory disclosures related to the contestability period. Therefore, option C is the correct answer, as it does not reflect a requisite component of a life insurance policy. Question 13. How does a ownership right ICA life insurance policy affect the beneficiary designation? A. The owner can change the beneficiary at any time without consent from the insured. B. The beneficiary cannot be changed once the policy is issued. C. Ownership rights do not influence beneficiary designations. They are solely based on the insured's wishes. D. The owner must obtain written consent from the beneficiary to change the designation if it is irrevocable. Answer: D. The owner must obtain written consent from the beneficiary to change the designation if it is irrevocable. Explanation: Ownership rights in a life insurance policy grant the policy owner the authority to manage the policy, including changing beneficiary designations. If a beneficiary designation is irrevocable, the policy owner must obtain written consent from that beneficiary before making any changes. This protects the rights of the irrevocable beneficiary and ensures that they have a claim to the policy's benefits. Option A is incorrect because the owner cannot change an irrevocable beneficiary without consent. Option B is misleading, as beneficiaries can generally be changed unless designated as irrevocable. Option C is also inaccurate, as ownership rights do influence beneficiary designations. Therefore, option D correctly represents the process for changing beneficiary designations involving irrevocable beneficiaries. Question 14. What is a policy loan provision ICA permanent life insurance policy? A. A feature that allows the policyholder to borrow against the cash value of the policy. B. A clause that enables the insurer to loan funds to the policyholder for premium payments. C. A term allowing the insurer to cancel the policy if the loan amount exceeds the cash value. D. A requirement for the policyholder to repay any outstanding loans upon death. Answer A. A feature that allows the policyholder to borrow against the cash value of the policy. Explanation: The policy loan provision is a feature found in permanent life insurance policies, enabling the policyholder to borrow against the accumulated cash value. This loan typically comes with favorable terms, as it does not require a credit check and interest is charged on the outstanding balance. If the loan is not repaid, any remaining balance is deducted from the death benefit when the insured passes away. Option B is incorrect, as it does not accurately describe the provision. Insurers do not lend money to cover premiums in this manner. Option C misrepresents the provision, as the policy remains in force as long as premiums are paid, regardless of loans. Option D is partially correct, as loans need to be settled from the death benefit, but the phrasing suggests a requirement that is misleading. Thus, option A is the most accurate representation of the policy loan provision. Question 15. What role does underwriting play in the life insurance application process? A. Underwriting determines the policy's premium based on the insured's financial status alone. B. Underwriting involves evaluating the applicant's risk factors to establish eligibility and premium rates. C. Underwriting is the process of issuing a policy without requiring medical exams. D. Underwriting assesses the beneficiary's qualifications to receive the policy benefits. Answer: B. Underwriting involves evaluating the applicant's risk factors to establish eligibility and premium rates. Explanation: Underwriting is a critical function in the life insurance application process, where insurance companies assess the risks associated with insuring a particular individual. This involves evaluating various factors, including health history, lifestyle choices, occupation, and sometimes financial information. The outcome of this assessment determines the applicant's eligibility for coverage and the appropriate premium rate. Option A is incorrect because underwriting does not solely focus on financial status. Health and lifestyle are also significant. Option C is misleading, as underwriting may still involve some form of medical evaluation, depending on the insurer's policies. Option D inaccurately attributes underwriting responsibilities to the assessment of beneficiaries, which is not a typical function of underwriting. Therefore, option B accurately describes the underwriting process. Question 16. Which of the following is a primary purpose of term life insurance? A. To provide a cash value accumulation for future use. B. To offer a death benefit for a specified period to cover temporary financial needs. C. To serve as an investment vehicle for long-term growth. D. To provide permanent coverage with lifetime benefits. Answer: B. To offer a death benefit for a specified period to cover temporary financial needs. Explanation: term life insurance is designed to provide a death benefit for a defined period, making it ideal for addressing short-term financial needs, such as income replacement during the working years, paying off debts, or covering children's education expenses. Unlike permanent life insurance, term policies do not accumulate cash value. Option incorrectly suggests that term life insurance has a cash value component, which is not true. Option C misrepresents the purpose of term insurance as an investment vehicle, which it is not, but such features are typically associated with permanent policies. Option D also incorrectly describes term life insurance as it is not intended to provide permanent coverage. Thus, option B is the correct choice. Question 17. When can a life insurance policyholder generally exercise a conversion option? A. Only at the time of policy application. B. At any point during the policy term without restrictions. C. Typically within a specific time frame prior to the policy's expiration. D. Only when the policyholder has reached a certain age. Answer: C. Typically within a specific time frame prior to the policy's expiration. Explanation: the conversion option in a life insurance policy allows the policyholder to convert their term insurance into a permanent policy. However, this option usually must be exercised within a specific time frame, which is defined in the policy terms, typically before the policy's expiration or the end of the conversion period outlined by the insurer. Question 18. What does an accelerated death benefit mean in a life insurance policy? A. A provision that allows the policyholder to access a portion of the death benefit while still living if diagnosed with a terminal illness. B. A clause that automatically increases the death benefit over time. C. A feature that enables beneficiaries to receive the death benefit in installments rather than a lump sum. D. A type of policy that guarantees a minimum payout regardless of the insured's life expectancy. Answer A. A provision that allows the policyholder to access a portion of the death benefit while still living if diagnosed with a terminal illness. Explanation: an accelerated death benefit allows policyholders diagnosed with a terminal illness to receive a portion of their death benefit while still alive. This feature provides financial support during a difficult time, enabling individuals to cover medical expenses or fulfill personal wishes. Option B is incorrect, as an accelerated death benefit does not involve automatic increases in the death benefit. Option C refers to a payment method rather than the concept of acceleration. Option D misrepresents the concept, as accelerated benefits depend on a terminal diagnosis rather than guaranteeing a payout. Thus, option A is the correct answer. Question 19. Which of the following is a primary characteristic of whole life insurance? A. It has a low premium than term life insurance. B. It provides coverage for the insured's entire lifetime. C. It accumulates no cash value. D. It is typically more affordable than universal life insurance. Answer: B. It provides coverage for the insured's entire lifetime. Explanation: whole life insurance is designed to provide coverage for the insured's entire life as long as premiums are paid. In addition to the death benefit, whole life policies also accumulate cash value over time, which can be borrowed against or withdrawn. Option is incorrect because whole life insurance usually has higher premiums than term life insurance. Option C is false, as whole life policies do accumulate cash value. Option D misrepresents the relationship between whole life and universal life, as premiums vary based on several factors. Therefore, option B is correct. Question 20. What is the primary benefit of a waiver of premium rider in a life insurance policy? A. Allows the policyholder to skip premium payments if they become unemployed. B. It provides a tax advantage for the policyholder. C. It waives premium payments if the policyholder becomes disabled. D. It guarantees that the policy will never lapse due to non-payment. Answer: C. It waives premium payments if the policyholder becomes disabled. Explanation: a waiver of premium rider allows the policyholder to stop making premium payments if they become permanently disabled. This ensures that the policy remains in force despite the policyholder's inability to pay due to their disability. Option is incorrect. The waiver of premium does not apply to unemployment. Option B is misleading and the rider itself does not provide a tax benefit. Option D is not entirely accurate because while it helps maintain the policy, other conditions must still be met to avoid lapsing. Thus, option C is the correct answer. Question 21. In a life insurance policy, what is the free look period? A duration during which the insured can review policy details before the policy becomes active. B. A time frame in which the policy can be renewed without reapplying. C. The period after a claim is filed when beneficiaries can review their options. D. A specific duration where the insured can borrow against the cash value without penalties. Answer A. A duration during which the insured can review policy details before the policy becomes active. Explanation: the free look period is a specified duration, usually ranging from 10 to 30 days, during which the policyholder can review the policy and decide if they want to keep it. If they choose to cancel during this time, they can receive a full refund of premiums paid. Option B is incorrect as free look does not pertain to renewals. Option C is misleading as the free look applies to new policies, not claims. Option D misrepresents the concept of borrowing against cash value. Therefore, option A is the correct choice. Question 22. Which of the following statements about universal life insurance is true? A. It provides fixed premiums throughout the policy term. B. It allows policyholders to adjust premiums and death benefits within certain limits. C. It has no cash value component. D. It is only available for short terms, typically under 10 years. Answer: B. It allows policyholders to adjust premiums and death benefits within certain limits. Explanation: universal life insurance is a flexible permanent life insurance product that permits policyholders to adjust their premium payments and death benefit amounts as their financial situation changes. This flexibility allows for better alignment with the policyholder's current needs and goals. Option A is incorrect. Universal life policies can have varying premiums. Option C is false as universal life does accumulate cash value. Option D inaccurately describes the term length as universal life policies can be structured for longer durations. Thus, option B is the correct answer. Question 23. What is the primary purpose of a life insurance beneficiary designation? A. To determine the policy's cash value. B. To establish who will receive the death benefit upon the insured's death. C. To outline the policy's premium payment structure. D. To specify the medical underwriting requirements for the insured. Answer: B. To establish who will receive the death benefit upon the insured's death. Explanation: the beneficiary designation in a life insurance policy specifies who will receive the death benefit when the insured passes away. This designation is crucial for ensuring that the benefits are distributed according to the insured's wishes. Option A incorrectly attributes beneficiary designation to cash value determination. Option C refers to payment structures, which are unrelated to beneficiaries. Option D misrepresents the purpose of the designation as it does not involve underwriting criteria. Therefore, option B is correct. Question 24. What does insurable interest mean in the context of life insurance? A. It refers to the insured's interest in a particular insurance company. B. It means that the policyholder must have a financial stake in the life of the insured. C. It describes the interest an insurance agent has in selling a policy. D. It denotes the importance of the insured's health history to the insurer. Answer: B. It means that the policyholder must have a financial stake in the life of the insured. Explanation: insurable interest is a legal requirement in life insurance stating that the policyholder must have a valid financial interest in the life of the insured. This ensures that insurance is used to mitigate risk rather than as a gambling tool on life events. Option A is incorrect. Insurable interest is not about an insurance company's interest. Option C misrepresents the concept by focusing on the agent's interests. Option D is unrelated, as insurable interest pertains to financial stakes, not health history. Thus, option B is the correct choice. Question 25. Which type of life insurance policy typically offers the greatest flexibility in premium payments and death benefit adjustments? A. Term life insurance. B. Whole life insurance. C. Universal life insurance. D. Variable life insurance. Answer: C. Universal life insurance. Explanation: Universal life insurance is known for its flexibility, allowing policyholders to adjust both their premium payments and death benefit amounts within specified limits. This adaptability helps align the policy with the policyholder's changing financial circumstances and goals. Option is incorrect, as term life insurance does not allow for flexibility in premium payments. Option B, whole life insurance, has fixed premiums and benefits, lacking the adaptability of universal policies. Option D, while offering investment options, does not provide the same level of premium flexibility as universal life. Therefore, option C is correct. Question 26. In life insurance, what does the term rider refer to? A, an additional clause that modifies the terms of the policy. B, a type of insurance that covers multiple lives under one policy. C, a temporary extension of the policy's coverage. D, a mandatory provision that increases premiums. Answer A, an additional clause that modifies the terms of the policy. Explanation: a rider is an addendum to a life insurance policy that modifies its terms, offering additional coverage or benefits. Common riders include the waiver of premium accidental death benefit and accelerated death benefit riders, allowing customization based on the policyholder's needs. Option B inaccurately describes a different type of policy, often called a joint policy. Option C is misleading. Riders are not temporary extensions. Option D incorrectly suggests that all riders increase premiums, which is not necessarily true. Thus, option A is the correct answer. Question 27. What is the main purpose of a contingent beneficiary ECA life insurance policy? A, to receive the death benefit if the primary beneficiary is unable to do so. B, to manage the policy's cash value during the insured's lifetime. C, to adjust premium payments according to the insured's health status. D, to specify the insured's medical history for underwriting purposes. Answer A, to receive the death benefit if the primary beneficiary is unable to do so. Explanation: a contingent beneficiary is designated to receive the death benefit if the primary beneficiary is unable or unwilling to accept it, such as in cases where they predecease the insured. This ensures that the death benefit is paid to someone designated by the insured, providing a fallback plan. Option B incorrectly refers to cash value management, which is not the role of a contingent beneficiary. Option C misrepresents the functions of beneficiaries, and option D pertains to underwriting rather than beneficiary designations. Thus, option A is correct. Question 28. What is a key feature of term life insurance? A, it builds cash value over time. B, it provides coverage for a specified period. C, it offers lifetime coverage regardless of age. D, it typically has higher premiums than whole life insurance. Answer B, it provides coverage for a specified period. Explanation: term life insurance is designed to provide coverage for a specific period, such as 10, 20, or 30 years. If the insured passes away during this term, the beneficiaries receive the death benefit. If the term expires and the insured is still alive, no benefits are paid and no cash value accumulates. Option is incorrect. Term life does not build cash value. Option C misrepresents term insurance as providing lifetime coverage, which it does not. Option D is also incorrect. Term life insurance typically has lower premiums than whole life insurance. Therefore, option B is the correct answer. Question 29. Which of the following describes a guaranteed insurability rider? A, it allows the policyholder to increase their coverage without evidence of insurability at specified times. B, it ensures that the policyholder can convert their term policy to a whole life policy without penalties. C, it provides a guaranteed payout in the event of a critical illness. D, it guarantees that premiums will never increase. Answer A, it allows the policyholder to increase their coverage without evidence of insurability at specified times. Explanation: a guaranteed insurability rider permits policyholders to increase their life insurance coverage at predetermined times, e.g., during certain life events, without needing to provide proof of insurability, which can be beneficial if their health deteriorates. Option B describes a conversion privilege, not a guaranteed insurability rider. Option C incorrectly refers to a different type of benefit. Option D misrepresents the nature of premium adjustments, as guaranteed insurability does not inherently prevent increases in premiums. Thus, option A is correct. Question 30. What does the conversion option ECA term life insurance policy allow the policyholder to do? A, convert the policy to a whole life insurance policy without proving insurability. B, increase the policy's death benefit at any time. C, change the beneficiaries without restrictions. D, extend the term of the policy for an additional fee. Answer A. Convert the policy to a whole life insurance policy without proving insurability. Explanation. The conversion option allows policyholders of term life insurance to convert their policy to a permanent life insurance policy such as whole life without needing to provide evidence of insurability. This is especially valuable if the insured's health changes during the term. Option B is incorrect because increasing the death benefit generally requires underwriting. Option C does not reflect the nature of the conversion option, as beneficiary changes can usually be made separately. Option D misrepresents the conversion feature, as it does not simply extend the term but rather switches the policy type. Therefore, option is the correct answer.